Hey, what is going on? Happy afternoon. It looks like we are headed into a recession, and we have some data to kind of prove that. This is good if you're looking to get into the real estate market or if you have some cash and you want to buy some assets. So that's what we're going to be covering today. So let's get right on into it. Firstly, we've got this bankruptcy filings by larger corporations in the first half of this year rose to the highest level since the same period in 2010 when they were coming down from the financial crisis. So if you see here, we had the oil bust, obviously 2010 coming down off that financial crisis, right? We had the pandemic, and now we have the end of easy money. Interest rates are not going to be where we saw them in the past anytime soon, in my opinion. I don't think it's going to happen in probably the next 5 years or so, probably. So we're going to have high interest rates, and the thing is they can't print either. They can't print their way out of this one because if they print, it's going to cause more inflation, which that's why they rose the interest rates to begin with. We've also got, it's a huge mess. The deficit spending, it's all going to cause inflation. We're stuck. The next 10 years is going to be really, really tough here. So first signal, we've got bankruptcy. This means layoffs. Right, that's the point of why I'm showing this. This means that we are going to have more layoffs. And we're not even like into the recession yet. I've got more data to show you here. Don Johnson. Microsoft announces new layoffs to come beyond the 10,000 employees already let go by Microsoft. Although this is mostly just the tech sector, right? There's been tons of layoffs in the tech sector. Amazon, crypto in general, right? Tons of projects just like shutting down in general. But largely, it's been tech. But there is coming the retail wave of layoffs. Do not think that that is not going to happen. That is typically lagging. They raise the rates. You figure there's something called the bullwhip effect, which it's like, think of a supply chain. You order something and they say, okay, I'm going to order some reserves, but then they have a supplier and it kind of grows into this massive supply chain. And it's like this huge, a small change happens here, but it takes forever to work its way through the supply system. So that's why there's this massive lag that's happening here. Redbook retail sales goes negative for the first time since the COVID collapse. 0.4% year over year shrinking in retail sales. Since the COVID collapse, right? So this is not good. Down 0.4%. And what this indicator is, Redbook, it surveys 9,000 retail companies to decide, and then they share their year-over-year sales. So this is just an indicator that retail sales are starting to decline, and when retail sales decline, that's when you're going to see, like we talked about, more layoffs. Like think Target, places like that, maybe even Walmart. Redbook retail sales, this is another just sort of graph illustrating this. Let's see, actually going back here, I think they had another one. There we go. So this puts it more in perspective. We had 2020, which was really bad, really negative, and now we've just gone negative here. So I wish that we could actually see a timeline. Like this is 2007, so this is what, like 2008, 9, 2008 and a half. So it wasn't until early 2010, well after the 2008, 2009 bubble burst, that we got these negative things here. So we're negative. It's likely just going to get worse. I already shared this graph, sort of a similar thing they're talking about. One that I don't know if you guys are paying attention to. Let me make myself small again. I always forget that I leave myself too big. I want you guys to see the things here. So cardboard box demand. If you weren't paying attention to it, if cardboard demand goes down, it's likely because there's nothing to put in the boxes. There's nothing to send. So Amazon sales likely down, or just inventory manufacturing in general. But look at this again. In the pandemic, right? Cerveza sickness, as some people call it, 2020 wasn't that bad. Look now. Look at the dot-com bubble. Really, really bad. An indicator that we are about to get into it. This is not good. It's just an indicator that retail sales, like all the other sales, are kind of down. So let's get into this. This talks about credit. Because yes, retail sales are down, interest rates way up, housing prices are starting to come down. They're going to have to correct. I can't wait to see the new data, make this stuff more affordable. Obviously, if you're flipping a house and you have that house right now, terrible time to be stuck in it. Hopefully, You can rent it out or do something with it, Airbnb, but I just did a video on Airbnb bust. That might not be that great of a solution. So there's always a solution, though. You just might have to get creative. So this is about the credit, and particularly it talks about auto loans. And I didn't know how some of this stuff worked here, but I do know. In the United States, we are a debt-based economy. If no new debt is created, the bubble has to continuously expand, or else the whole thing is going to collapse. That's why we're going to have some sort of reset. There's either going to be a massive depression or this fabricated great reset that, certain central planners are trying to do, except that is not going to be necessarily good, in my opinion. Combine that with the CBDC. They're trying to lock in their power, and money may not even be like a real thing, right? It'll just be credits. How good are you to the government? Here's your credit amount to go buy yourself some food that they control the complete supply of, all that stuff, right? Not to be too doomsday. Hey, what's up, Jerry? I see you over there. By the way, if you're here and you're liking the video, do please hit the like button. It helps spread the video around so people know I'm going live right now. Helps the channel. Appreciate it. So yeah, let's get into this consumer credit. So revolving credit and interest charged on credit cards hit a record high. We know this. Like the United States, Americans are $17 trillion in credit debt. And that's what's called revolving credit. You put money on your credit card and then hopefully you pay it off. So that is revolving credit. But then you've got other types of credit that we're going to talk about here that can be killed, right? You take out a loan and eventually you pay off that loan, and that money, that existence of that credit, which was new money created, dies because you paid it off. When you pay off the principal, you pay off the interest, you kill all that money that is in the system. So May U.S. consumer credit grew by a paltry, as they say here, $7.24 billion, down more than 50% from the downward revised $20.3 billion in April. And look again here. This was the Cerveza times, and we could see what happened there. And look what is happening to credit now. It is pretty low. Usually it is much higher. This is a huge miss. So without that credit expansion, things contract or it is stagnant. That is literally how the system is designed to work. So this was the lowest monthly increase in consumer credit since November 2020. And for an economy like that, the U.S. is entirely relying on credit growth. We already kind of talked about that. May revolving credit rose by $8.5 billion. So what happened is something had to have come out because, as we said, it was $7.5 billion up here, right? $7.2 billion up here. But revolving credit, which means credit cards, actually increased by $8.5 billion. So what in the heck is happening? What's the shocker? The shocker was the non-revolving segment, also known as student debt and auto loans, which unexpectedly dropped by $1.3 billion. They say they think it's auto loans because student loans, no one's paying those back right now. They've been in forbearance since like 2020, right? No one's paying their student loans. They're hoping that they get forgiven, which would be terrible for the economy, good for the student loan people, although maybe not. I won't get into that one. That would cause inflation, money printing, all of that stuff, right? This is a shocker because while the monthly change in revolving credit can fluctuate significantly month to month, the non-revolving credit increase has historically been a consistent $10 billion. And a lot of that, student loans and auto loans, right? But it is now in the negative. It has, look at this. Again, pandemic, recession. Where do you think we're headed? If you've got an opinion on that, let me know in the comments. Do you think that some people think that we're not even going to have a recession? Absolutely insane to me. I don't know how, if you're looking around at all, you could say that we are not going into a recession, but it's not looking good. So what's happening is people are paying down their auto loans, or rather they're just paying down their cars and they're not affording these auto loans, because just like mortgages, the rates on auto loans have gone up to 7.81%, which is just shy, like barely 0.01% of Q3 2006, right before obviously everything blew up, right? 2008 or so. So no one can get a car loan. And if you look at credit, 22.16% on your credit card debt. That's insane. right? That's insane. So we have hit a brick wall. The economy has. Consumers are no longer spending, and this is the first sign of it. We're going to see a contraction. We're probably going to see some deflation, and we are definitely going to see a recession as these companies, the bankruptcies tick up, the layoffs happen, and it becomes a loop, right? A recession doom loop, I guess you could call it. Nobody wants a recession, but it's coming anyways. What that means for us, though, in real estate is there will be more people that need us as wholesalers and flippers or whatever, strategy you're using to help them with their real estate situation that they're in. That's what we do, right? Is try to help people that are in weird situations with houses get out of them in a way that they feel comfortable with. That's it for this video. If you liked it, don't forget to hit the like button, subscribe, hit the notification bell for more stuff in the future, and I'll see you on the next video.